Coming up today, stocks finished the week lower. Will the summer rally continue? The latest on earnings. What stocks could be really cheap right now? The big moment for stablecoins. Will Trump get tested on tariffs? And how retail investors are beating hedge funds at their own game. It's been another great week, guys. Let's go. And just as the VIX one-day index forecast yesterday, the indices pretty much finished flat here today, with S&P and Qs just off a touch. It was a rather uneventful OPEX, options expiry, as today was the third Friday of the month. And once again, a bunch of checkered breadth looking underneath the hood as we're ramping up into Q2 earnings season. We actually saw Netflix come off a bit today after reporting earnings yesterday. Many healthcare stocks still under pressure, and once again it was mega cap tech led by Tesla performing the best there. And to switch in the heat map over to this week, that was pretty much the story. For this week as a whole, healthcare stocks coming off along with energy, oil and gas, a few perk ups in industrials, banks coming through with good results, but once again, it's the big mega cap tech doing well, especially the AI trade, Palantir up 8% for the week. But the big story for the week was the best performing major asset, Ethereum, up almost 20% of the week as we got the watershed moment officially signed into law for stablecoins. So stick with me today, I'll get more into that later on and show you some of the hottest stocks moving out in the market, which could have further to run next week, as even though the S&P 500 is largely consolidating just below highs on really low volatility, underneath the hood, looking at some of these smaller growth stocks, we've got plenty of runners out there, even again today, as key categories like space, drone, and rare earth stocks have also had a fantastic week. But more on that later. Since we've been on such a great run, sentiment has finally caught up. Now got the fear and greed index in the extreme greed zone for over a week now, for which many in the mainstream financial media are attributing that to the so-called dumb money, referring to us, active retail investors, for which we now account for over 20% of the total volume traded on the NYSE and NASDAQ, significantly larger than the 15% for hedge funds and long-only institutional investors. We're now literally a bigger force than them. And in fact, JP Morgan thinks we could pump another $500 billion into the market, giving it further tailwind to keep pushing higher in the second half of this year. As the number one theme driving this market, artificial intelligence continues to light up, in addition to other big themes like crypto, fintech, and more recently, battery stocks and the commodities that are needed for them. And just like we saw back in 2020, retail traders can actually help revive struggling companies. As they did with GameStop, we're doing it again with Opendoor, a beaten down real estate stock involved in the business of flipping properties. And that can make a material difference to the company, because when a stock trades below $1, they'll get a letter from the exchanges warning them that they could be delisted if they can't get it back above. And that causes a further loss of confidence amongst investors, partners, suppliers, customers, and everyone. And so a stock going viral online and attracting a lot of retail investors causes huge moves like this that we've seen in open these last few weeks, rallying from around 55 cents to over $2.20 today and still ripping after hours as I speak. And so what you'll typically see after this, when the stock's being pumped up online, the company will come out and do what's known as a secondary offering. When a company's first come onto the market, that's the primary offering, initial public offer, and that's the whole point of companies coming to the stock market, is they can raise capital to finance expansion plans and also serves as a form of liquidity for investors and new shareholders to come and go. And so just like GameStop and many other companies, Tesla also took advantage of this with their lofty valuation. It allows them to raise capital, replenish their balance sheet, and give the business a real chance to keep on operating. And so that's the real material effect that retail investors can have in the market. It's not just all a game of number go up. These actions can save thousands of people's jobs in the real economy, as well as hopefully make us a profit for doing so. And in addition to reviving struggling companies, many of which have been heavily targeted by short-selling hedge funds, and that's something that attracts retail investors, is stocks that have a high level of short interest, but the company has the potential to turn around, especially if they had the capital to do so and restoring confidence. But in addition to helping bring companies back, our capital can also power new industry like space exploration. These companies are not profitable. Traditional value investors don't even want to look at this stuff. They snub their nose at it because it's too risky, it's too unknown, and a lot of them don't even understand it or want to even learn to understand it. But us retail investors have more of an appetite for risk, which many of the greatest leaders and entrepreneurs will tell you is actually required to succeed. Most people play it too safe to their own disadvantage. But it's retail investors really driving stocks like Rocket Lab, again putting them in a healthy capital position and creating that positive halo effect across the whole company that gives them the capacity to spend on research and development, innovate, create new products, create new jobs, and pretty much create a whole new industry. And that's what a growth-led bull market does. It lights a fire under innovation and new technologies, as investors aren't demanding profits right now, but that's what a crash does. Weeds out the weekends, and the market focuses on efficiency and profitability, and that's when you typically see industries consolidate. These emerging industries spawn hundreds of new players, but then when the boom eventually tops out, a lot of the weak ones will die off, and those in the middle will usually get snapped up. And then when the industry matures, you'll typically be left with 3 or 4, maybe 5 dominant players that have 80-90% of the market share in total. And that's exactly how it played out with the automotive industry over the last 100 years. Back in the early 1900s, when Henry Ford and the Model T was all the rage, there was over 400 automotive-related stocks listed in New York. And now as the industry's well and truly matured, there's really just a handful, and it's kind of morphing with the electric vehicle industry as well, which is still in its early stages, seeing a boom with many players. And not only that, according to data from Goldman Sachs, they think retail investors have been beating the hedge fund gurus over the last couple of years, and especially since April lows. And I remember reporting on that here on the Daily Market Review. We've seen big levels of retail investors buying the dip, whilst it was actually hedge funds, institutions, and Wall Street bailing, calling for a recession. Turned out us retail investors were actually right. And that's after so many of them said we couldn't do it. The smart money's always right. Us retail investors are always wrong. But I beg to differ. And I think a lot of people would be surprised at the sophistication and returns of most of the so-called smart money. And I've had a first-hand look at this. Previously working in an investment bank myself, most of them were just in the right place at the right time and happened to manage other people's money. They're not in some dark underground lair or colluding together how to beat us. They're trying just as hard to figure everything out as we are. And we actually now have access to the same information as they do. And as retail investors, we actually have the advantage of being smaller. We can get in and out more quickly and with less slippage than what hedge funds do as well. So that's more the big picture, but just zooming in here in the short term, no doubt things are getting a little frothy. Many key stocks, which I'll show you on the charts a bit later on, are getting a bit technically overbought. We're getting some reversal signals. We're in the extreme greed zone. And as famed technical analyst Tom McClellan correctly pointed out today, the VIX index did not confirm the higher S&P 500 price, meaning there's a little bit of a divergence. As the S&P is sitting at all-time highs, and I was expecting the VIX to take out lows as well, which it normally does when we hit all-time highs. So the VIX can grind lower, especially as realized volatility is super low in the market. So there is a little bit of a bid there in option prices, but not too much. As we can see in the skew index, price out of money put options still well off highs, so there's not too much fear out there, but we still don't have the best breadth. We got the mega cap tech dominated indices at highs, but still plenty of stocks well off highs. Even in the short term, only 57% of S&P 500 stocks above the 20-day average, and looking at the long-term average as well. We're still a bit off highs at 58%, and stocks making new highs as well. Hasn't really pushed up hard of late, but that can be looked at in one of two ways. It's a divergence with the market, as most stocks are not confirming new highs, or there's potential for many stocks to catch up, and that can play out in those both ways as well. With a market-wide correction, or the mega cap tech dominated indices can stall out and consolidate whilst the rest of the market actually catches up. And that might already be underway. Looking at the most broad-based index, the Russell 2000 versus the equal weight S&P 500, has been drifting higher the last couple of months, but it too still well off highs. Plenty of room for small caps to catch up here, as they are still on a record divergence of valuation with large caps, and the big beautiful bill may actually be the fundamental catalyst that can put a bottom in that spread, because it is right now currently at extremes. Just looking at the ratio of the market value of the 5 biggest stocks to all small stocks combined. Unbelievably, the 5 biggest stocks in the market are 4.93 times the size in market cap to the entire Russell 2000 index. And we can see for a large part of this century, there was only a slight premium of the top 5 to the Russell 2000. And that's why when you talk about the market, you've really got to put it into context, because these mega cap tech stocks are kind of like in a world of their own. It's almost like they trade on a completely different market and exchange compared to a lot of other stocks out there, and the valuations can vary wildly as well. But in addition to trade deals and tariffs, we're also right on the doorstep and start of the seasonally weakest period in the market, July through October, which will often see consolidation, especially if we've already had a great run like we did in Q2. Seasonality would suggest that we consolidate for a few months here. But what could overwhelm that is great earning. The biggest driver of stock. And that's why these big tech companies keep doing well, because we increasingly live in a digital world, and due to their scale, they can just dominate with great margins. And we saw that once again with Netflix delivering great numbers. Even though the stock came off a little bit here today, it may have been a bit of a buy the rumor, sell the news, as the stock had increased by over 60% off April lows. So no surprise to see a little bit of profit taking here today. And it may actually be the market starting to acknowledge that their biggest competitor isn't other streaming companies, but YouTube, which is getting more and more into premium content, in addition to being the overriding dominant platform for amateur content worldwide. And that continues to accelerate. On average, people spend more time watching content on YouTube than Netflix, and that gap has been widening this year. And YouTube could very well be on its way to overtaking all forms of cable combined in market share. We'll get to hear more on that this coming Wednesday night, but also interesting to see Netflix revealing that one of its shows used generative AI for the first time. And I've been seeing this on YouTube as well, AI generated videos, as it gets more and more harder to distinguish between what's real and what's AI generated. Maybe I'm an AI, or I could train an AI to overtake me one day. In addition to tech, we've also got financial companies still growing leaps and bounds. Even in this high rate environment with so many consumers struggling, we saw the classic boomer wealth management company Charles Schwab just beat Wall Street estimates and actually reporting a 31% year-over-year increase in net new assets of 80 billion, along with their daily average trading volume increasing by 38% on the same period a year ago. And so even though companies like Robinhood are coming for them, better positioned with the millennial, these boomer stocks also continue to do well, with my momentum thrust indicator firing off once again here today. And we're still early days into the Q2 earnings season, but so far so good. In fact, we're off to a great start. 12% of S&P 500 companies are reported. Of them, 83% have reported EPS above estimates, which is well above the 10-year average of 75%. And considering the forward PE on the market, just a bit above 22, not all that crazy considering we're still getting really healthy growth here in corporate earnings. And it isn't just a tech story either, of where we're getting beats, as we've been seeing with the financials, but also healthcare, consumer staples, and even some industrial stocks coming through with beats. And next week, we really start getting into the thick of it, hearing from the first of the mega cap tech, Tesla and Alphabet on Wednesday. I'll also be paying attention to Intel on Thursday afternoon, along with a few other consumer favorites to start us off for the week. But we've just had a raft of good news in the market this week. Good print on wholesale, PPI inflation, retail sales better than expected. Beige Book showed a resilient economy. Q2 earnings off to a great start. Coca-Cola is going to use cane sugar, and Nvidia helping to thaw relation between the States and China, so he can sell his nifty little gadget known as GPUs to them, a big, important, growing market, which also fundamentally locks in the Chinese with American technology, gives the Americans leverage, and also reduces the risk of a spillover or military conflict over Taiwan, a very important part in the supply chain of semiconductors. And I do believe corporate earnings can continue accelerating on the upside for several years, as the corporate world has just begun its embracement, adoption, and integration of artificial intelligence throughout their businesses. And I think we may see a new trend of both unemployment and corporate earnings rising at the same time. As I know, AI and robotics will create new jobs, but I believe they will disappear jobs at a faster clip than new ones they can create. Not everyone can be a robotics engineer. And I know it sounds a little dystopian, but it's the reality, and I think that's going to squeeze earnings per share to the upside. And another under-discussed tailwind for mega cap tech is they generate half of their sales outside the States, and this administration's pursuit of a weak dollar is a huge tailwind for them. When they repatriate that revenue back into dollars, it's worth more. And so you could think of the stage one of the AI revolution as the infrastructure build out, and that's having second and third world order effects, especially as we go into physical AI and robotics, I think is the next big stage, as we're still in the initial infrastructure build out. But all of this new technology needs an incredible amount of not only data processing and storage, but physical power. And I think nuclear is the perfect match for that, along with strong tailwinds coming from the government, not only with deregulation, but incentivizing for all this stuff to be sped up instead of being slowed down. And we got another taste of that today with Talon Energy, ripping higher after it said it would acquire 2 new power plants. This is on the back of the deal, which we saw late last year, them partnering with Amazon and a deal to provide them nuclear energy. And the market just absolutely loved that, shooting shares up 24% today on massive volume. In addition to others in the sector like SMR, also hitting all-time highs. Seeing a lot of volume coming this week. And uranium itself also sitting at 15-year highs. And so we may have the most pro-business administration the States and world has ever seen. And in addition to nuclear energy, what else could benefit from the new big spending spending bill being signed into law. I think that's what's really helped this stock market rally off April lows, maybe overwhelmed the fears to do with tariffs and inflation. Well, according to research firm Ned Davis, they've identified several areas of the market they think will benefit from the big beautiful tax bill. Among the biggest, they think defense, with $150 billion in new spending, with more to come on the back of the desire to build a Golden Dome defense system to guard the US from missile attack, similar to Israel's Iron Dome defense system, the best in the world. The administration's also increased NATO to come to the table and chip in their fair share for essentially their own defense. And that's something the market has seen coming for a little while now. One of the best performing ETFs of the last couple of years, the Global X Global Defense Technology ETF under ticker symbol SHLD, SHIELD. And just look at this weekly chart, parabolic, bottom left to the top right. Market couldn't gobble up that April dip fast enough. Big bullish engulfing candle there, and off she went. Ned Davis also recommends energy, both fossil fuels and nuclear energy. And of course, how can we forget about crypto with the president's own family involved in it? Doesn't get much more bullish than that. And so with European countries realizing the need to defend themselves, that's good for American defense companies who will sell them a lot of this military equipment in order to do so. And the best way to play that is the iShares US Aerospace and Defense ETF, ITA, which has also been outperforming the market and actually screamed back to all-time highs, which was one of the first sectors to do so after the April dip, got right back there just a few weeks later in early May. And there's a look at the top 10 companies in this ETF, GE Aerospace, RTX, Boeing, and a bunch of other defense blue chips. Moving on, we just got word that Block, formerly known as Square, is the latest to get added to the S&P 500 index after close today. And there's a look at Block, ticker symbol XYZ. They operate Square and Cash App, 44 billion market cap, and just going down to a 5-minute chart after hours, did shoot up about 10% on the back of that news. And many investors had been hoping it would be Robinhood, which is now almost 100 billion market cap, that was going to get added, and hence why it came off a few points after hours. But I think it's definitely still highly likely the S&P committee will have to add Robinhood to their signature index. It's just too big and important to ignore. Also want to keep an eye on other frontrunner AppLovin, even bigger than Robinhood, 123 billion market cap. I'm keeping this one on my options trading watch list for potential bullish plays, as I think this too is highly likely to be added to the S&P 500 index at some point this year. Moving on to crypto. It was a successful crypto week. It went all as planned, all as forecast, and all as everybody had hoped, with key bills getting passed and now signed in by the president, the Genius Act, bringing regulations to stablecoins, and which has been another win for this administration, bringing clarity and certainty to this industry, which has been in limbo for a couple of years now, and it kind of just digitizes the US dollar into stablecoins. Backed by treasuries, which is another form of demand for treasuries, another way to help keep yields low, and I think it's going to help the US retain its global currency reserve status, leading the charge in digital payment. Just as we heard from Treasury Secretary today, blockchain technologies will power the next generation of payments, and the US dollar is coming on chain, which will help cement the US dollar as the global reserve currency for generations to come. And we're even getting news that the White House could be receptive to making Ethereum a strategic reserve asset, with the president's family company also buying $5 million worth of ETH this week. And this has all happened really quickly. Wall Street doesn't have a choice now but to jump on board, as the floodgates have been opened on stablecoins, with the full backing of the federal government. And so expect more and more headlines every week now, like this one today, Charles Schwab to launch Bitcoin and Ethereum trading services, as we once again see Ethereum on the biggest crypto exchanges like Binance actually do more trading volume this week than Bitcoin, along with many companies selling all their Bitcoin, switching fully over to Ethereum, with a huge advantage of staking, generating a yield, which is also coming for the Ethereum ETFs. Key difference and big tailwind over Bitcoin. And that's why the relatively new ETF had one of its best weeks ever, and in fact just gave us a momentum upward thrust signal as well. Not to mention finishing more than 20% higher versus Bitcoin, coming off these multi-year lows, a really good technical sign confirming the fundamentals. And once again, more signs of big Bitcoin whales. Some of these Satoshi era wallets that have been dormant for years are waking up and actually selling Bitcoin. We just got another one today. Almost 10 billion offloaded that was bought all the way back in 2011 for a mind-blowing $54,000. And I think that's what they call diamond hands. And I agree with Coinbase CEO Brian Armstrong. The signing of the Genius Act is a watershed moment, which has kind of taken the whole financial world by storm, considering where we were only 9 months ago. But it could very well turn out to be the official start of the financial revolution in the US. And Coinbase is a big beneficiary to Ethereum as they get half of all the revenues from USD Coin, the stablecoin operated by Circle, which is not surprising to me to see it get a premium valuation right away, market cap 50 billion. And a lot of others out there will say, oh, it's got a PE of 150 or this, that, and the other, but market doesn't care about the earnings per share over the last 12 months. It cares about what's possible over the next 2, 3, 5 years, even further. Markets are very much forward looking. And this company pretty much owns the bridge of the second largest stablecoin after Tether, which I think USD Coin will overtake as it's much more transparent and legitimate. Not to mention Coinbase has a big ETH reserve of their own, with the coin briefly hitting 3,600 earlier today. But are we a little stretched here in the short term? Now that this news has come and passed, Genius Act's been signed into law, has the buy the rumor, sell the news played out? Because you guys will remember a couple of weeks ago when I was just above 2,500 a coin, and we can go to my seasonality forecast indicator and use a custom time. And just like I said to you guys back then, there was some bullish seasonality coming into it over the next couple of weeks, along with it compressing up on this bull flag formation. But that was just the technicals. This time, the fundamentals were actually leading. As I did a deep dive into it back then, I could see what's coming, and it played out beautifully. I've had a good couple of profitable trades on the back of that, which I've already closed. And so now technically we've got 5 reversal signals, a little bit of bearish seasonality over the next couple of weeks. We're 31% above the 50-day VWAP, and the DSI is at a huge 22.39. Last time it was at these levels, back on the 10th of May, the price was close to peaking out, and then it stalled for a couple of months and consolidated. And same with other key stocks like Coinbase. We're getting some signs we're a little frothy here. The move could be close to getting exhausted, bearish seasonality, and along with Robinhood, as they come into their earnings, we may see a little profit taking as they've been on such great runs of late. But I'm just talking short term here. Could be a good time to take profits on any swing trades. But that doesn't necessarily mean I would go shorting it here because the fundamentals are so strong. The dips may get bought up straight away. And if you guys are interested in checking out all 28 of my custom trading view indicators, click the link below this video. Head on over to my website, clickcapital.io, and check them out for yourself. I've been developing these for over 10 years. It's all I pretty much use. I no longer use free indicators like most people, and some of these are exclusive on the TradingView platform. You won't find them anywhere else, and I've actually got 2 new ones coming next week, one I'm really excited about. Retail Interest Index. I coded this up to give us an idea of the level of retail traders' interest in stocks. As we're such a big force now, we can cause these explosive moves, and so you can use this indicator to see where it's rising, where there could be a divergence with price, and when it gets red hot, we're often closer to the end of the move. And you can also use it to see what stocks have had an explosion in retail interest in the past that could potentially do so again in the future. And so in addition to Rocket Lab, other retail favorite stocks like Oklo, Applied Digital, which this indicator has been suggesting retail interest has been building the last couple of days. And of course, look how red hot Quantum's been. But what you'll notice on the old school blue chip stocks like Procter & Gamble, McDonald's, and Walmart, there's just simply low levels of relative retail interest. So I'm really excited to release this indicator next week, along with another one I'm still finishing up. Stay tuned into this channel and I'll let you know what that is and how you can get them for a good discount as well. Make sure you subscribe to this channel, click Capital, to be notified of that next week. And speaking of hot retail stocks, some of the best performing today, STEM and a few others like battery stocks. I told you guys on Wednesday to keep an eye on EOS Energy Enterprises. I think it has a good chance to become a retail favorite. And they design batteries for the storage industry. And I could actually see on my retail interest index indicator that retail interest was building, but we still haven't gotten to those crazy levels that it has done in the past. So this has potential to uncoil even further, just like a few others do. AI healthcare getting some attention and a bit of a pickup back in fintech stocks. And of course, rare earth stocks have been on fire of late as well, on the back of big headlines and political tailwinds, helping to drive these stocks higher. And so like I said, even though the indices are just grinding and consolidating somewhat, we've still got plenty of momentum in these hot names. Established trends in nuclear, quantum, space, but I think we're getting new themes emerge, like rare earths, critical minerals, batteries, drones, energy storage. And I think after that, we could see robotics be the next big theme, potentially later this year or next year, as AI continues to move into the real world. And just wrapping up with what to expect next week, in addition to earnings, we don't have much on the economic calendar coming, but we're getting down to crunch time with the 1st of August, which will be the week following next, and whether we're going to get extensions or we're going to get a big trade deal with Europe. Right now, the market seems to be ignoring it or not caring, but it very well could because, like Goldman Sachs thinks, the effective tariff rate by the end of this year could be 17%, which someone has to eat that. And if it's more the US consumer than where it's targeted at the exporters, that very well could give us a few upticks in CPI inflation. I still think a September rate cut is on the table, but none of us have really seen this level of tariffs before in our lifetime. So nobody knows exactly how it's going to play out, but I don't think it will create structural inflation. I just think it could be a bit of a speed bump as the economy and markets adjust to a new reality. But that will be a theme playing out over the next couple of weeks. Also, the direction of rates. We just heard yesterday Fed Governor Christopher Waller come out with an official statement, the case for cutting now. He believes the Fed should reduce their rate by 25 basis points at their next meeting later this month, in which he may be signaling to Trump he's the man ready to do the job and take Jay Powell's place. So this is another theme playing out through the market. Otherwise, we'll be really looking forward to earnings from Tesla and Alphabet Google next week. Those big events the market could key off as it continues to grind on really low volatility coming into this seasonally weak period. Thanks very much for sticking with Click Capital. I appreciate your support of this channel. Have yourself a relaxing weekend, and I'll see you back here come Monday night. Cheers.